The stock market is a marketplace where investors can buy and sell shares of publicly listed companies. It serves as a platform for companies to raise money for investors to earn potential returns on their investments. Here are the 3 key components of the stock market. 1. Shares. These represent ownership in a company. When you purchase a share, you own a small part of that company. If a company issues 100 shares and you buy 10 shares, you own 10% of that company. While stocks and shares essentially mean the same thing, they are used in different contexts. A share refers to an individual unit of ownership in a specific company. For example, I have 100 shares of CBA. Stocks is a broader term that represents ownership in one or more companies. For example, if you own multiple stocks, it means you have ownership in different companies. So maybe you have 100 shares of CBA, 50 shares of Apple, and 20 shares of Amazon. The second key component is the stock exchange. These are organized venues where stocks are traded. Major examples include the New York Stock Exchange and the Nasdaq, which contain some of the biggest US companies like Apple, Google, and Nike. In Australia, we have the Australian Securities Exchange, or ASX for short, which lists all publicly traded Australian companies like CBA, BHP, and Woolworths. And the third key components are the investors. These are people who buy and sell shares aiming to profit from market fluctuations or dividends. The simplest way to invest in Australia is through an online broker or investing platform. These days you can sign up with an online broker and start investing within minutes using your smartphone or computer. How stocks make money? Stocks make money in 2 ways. 1. When the share price goes up. For example, let's say you bought 10 shares of a company at $100 each, worth $1,000 in total. If the share price increases to $120, you'll make a total profit of $200, before taxes of course. The second way stocks make money is through dividends. Some companies, especially bigger, more established ones, pass on some of their profits to their investors in the form of dividends. Please note, a company is not legally required to pay dividends, but a lot of Australian companies in particular like to offer them to attract more investors. How do stock prices go up and down? At the end of the day, it's all about supply and demand. The stock price of a company is influenced by various factors, including company performance, economic indicators, geopolitical events, and investor sentiment. But here's the tricky part. No one knows for sure which way the market will go. It's often like a guessing game with share prices moving up and down based on people's expectations. That's why investing in individual companies is riskier. The stock can drop down to zero if the company goes bankrupt. However, there's usually more potential upside if the company performs well. Most beginners or risk-adverse investors choose to invest in index funds or ETFs. This allows you to invest in the entire stock market through a single investment. An ETF typically tracks a market index like the S&P 500, which includes the top 500 US companies, or the ASX 200, which contains the top 200 Australian companies. By investing in these ETFs, you're essentially investing in the entire market. ETFs are like normal stocks, which can be purchased from the ASX. Stock market performance. Historically, both the Australian and US stock markets have returned approximately 8 to 10% on average per year over the last 100 years. While some years have performed better than others, the data shows that long-term investments typically increase in value. However, please note past performances do not guarantee future results. Please use historical performance as a guide only. Also, please note these historical performance are average return per year. A lot of beginners see that the stock market returns 8 to 10% per year, so they expect it every year. The stock market does not really work this way. Some years it may return 15%, some years it may be down 10%, and other years it might not do anything at all. So please keep this in mind if you're a beginner. And remember that investing in the stock market carries risks, so it's essential to do thorough research or consult a financial advisor before you start investing. Oh, and the secret word today is raspberry, so comment down below so I know you made it this far. If you're interested to learn how to start your investing journey this year, go check out this video on screen where I'll show you how to buy your first stock in Australia as a beginner. Thank you for watching, I appreciate you, and I'll see you in the next video.